Welcome to Lesson 3, Part B. We are going to talk about model maintenance. In the previous video, we have acknowledged that the track record of a MASASP trading system results from the grouping of the track records of all years within the observation period, and each year has been subjected to a specific predictive model trained on all years but the year in question. For instance, trades occurred in year 2017 results from a model trained on all years but 2017, and this model can be referred to as a 2017 specific model. This model might be slightly different from that utilized for year 2016 or year 2015. Well, the complete 12-year track record involves a collection of models which might be slightly different from each other. Well, we have to rephrase a bit the last sentence. Let's say that there is one single model that can evolve from a year to another, so that we potentially wind up having more versions of this model throughout our long observation period. One version for year 2014, another for year 2015, and so on. Our aim here is to analyze this modal evolution across time and see if it's pretty stable, meaning that it doesn't change from a year to another. So, we ask ourselves the following questions. Do predictors change as time goes by when another year is added to the training set? Is this collection of models stable enough? We go for stable models. Stability is a good property, as it proves that the predictors incorporated by the model have a long-lasting significance. When the model is stable, it means that the predictors involved represent some reliable dynamics in the pricing of the financial issue. Well, that is, though, just one facet of the coin. Let's see the other facet of the coin. Sometimes predictors actually lose significance over time. Thus, the predictive model must be capable of recognizing this change and adapt itself accordingly. Let's say that it must be able to promptly adjust. Well, I'm going to show you a couple of examples to this regard. The first example is mentioned in the Kirkpatrick book on technical analysis. It's the volume related to the odd lots, which used to play the role of a sentiment indicator, as it was the small investors, then the uninformed investors, who mostly utilized this investment vehicle. This predictor completely lost its significance as soon as call options started becoming popular among the small investors, replacing the role that odd lots used to play as an investment vehicle. Another example relates to proxies. Let us assume that we are trading gold and we use its implied volatility as a predictor. We know that the implied volatility of gold is quoted by the Chicago Board Options Exchange. Scholars would object that it can't be referred to as the implied volatility of gold because it doesn't deal with options on gold, but with options whose underlying is the State Street Gold Shares ETF, the largest ETF in the world intended to replicate gold. Said ETF, nonetheless, is an extremely good proxy for gold. Then, its volatility is very closely aligned to that of gold options. Its implied volatility, then, is a predictor which is not likely to lose significance over time. Things would be quite different instead if we replace the ETF above mentioned with a single stock, let me say the Newmont Corporation stocks quoted at the New York Stock Exchange. The core business of this corporation is gold extraction, then its revenues are going to be highly correlated with the gold prices. Nonetheless, sometimes specific factors with an impact on this company profitability might turn out to disrupt this high correlation. For instance, something strictly related to the management of this company, namely a higher leverage ratio, or a change in the dividend distribution policy, or underestimated provisions for liability, and so on. When something like this occurs, the predictor based on this stock will start losing its significance, and that it would be even more true if we took stock volume or warrants instead of the implied volatility. Who could grant that these predictors would be stable over time? Let's try to summarize all that. Drawing conclusions, we need a model maintenance policy which hits on a trade-off, taking account of both facets of the coin. Stability and prompt adjustments to cope with predictors which lose significance over time, if any. MASASP approach to these regards hits on a compromise, but it is a bit biased towards the first goal, towards stability. It is said to be a long retention approach in that it makes use of a big historical depth. All the years shown here, that's necessary to conduct statistical tests. Samples must be big enough to let us figure out statistically significant patterns. Secondly, that serves the purpose of including critical years, at least 1 year with a financial crisis. Hence, It is a good approach, but somebody might argue that it may fail to promptly adjust if and when predictors downgrade. Here, we schematize the opposite of the MASASP approach, then a short retention approach. Look, just few years as training set. This approach fails to deliver the benefits of the long retention approach. Nonetheless, it is at least capable of promptly adjusting if and when a predictor downgrades. Let's see a real-life example related to the short strategy on gold. Let's take a look at the outcome of the segmentation component, which is called stability tree map. This is the tree map arranged by predictor for the sake of precision, meaning that the big cells represent predictors and the smaller cells within them represent the years. At the bottom left corner of this chart, we find a big cell which has 12 smaller cells within it. That means that the predictor in question was significant in 12 years across the whole history. Besides, that significance was always of the highest grade, which is indicated by the darkest shade of green of these cells. That predictor is 100% stable over time. Great. Above, at the left-hand side, we have another predictor which was significant on 7 years out of 12. That is pretty stable as well. At the bottom right corner, we have another pretty stable predictor. These other two predictors instead are rather incidental predictors, meaning that they have been incorporated in the model just on few years. Besides, their significance is of the lowest grade, which is indicated by the lightest shade of green of these cells. That sounds good. It is apparent here that even if the long retention approach has been adopted in MASASP, which is biased towards stability, the models are though able to adjust a bit from a year to another. Great! Thanks for watching, and see you at lesson 4, where we will tackle the sensitivity analysis tier.